The perspective of the U.S. Treasury emphasizes the security and reliability of Treasury securities. Critics, however, often highlight different aspects. They argue that the massive issuance of U.S. Treasuries reflects the significant national debt, which stood at approximately $34.9 trillion as of July 2024. They contend that this growing debt could pose long-term economic risks, including potential inflation and increased borrowing costs. Additionally, they emphasize the U.S.'s dependence on foreign investment, particularly from countries like China and Japan, which hold large amounts of U.S. debt, around $1.15 trillion and $1.1 trillion respectively, as of early 2024. Historical overview of China's share of U.S. Treasury securities. China's significant accumulation of U.S. Treasury securities began in the early 2000s. During this period, China's export-driven economic model resulted in substantial trade surpluses with the United States. These surpluses led to an increase in foreign exchange reserves, which the Chinese government invested in U.S. Treasuries to ensure liquidity and safety. By 2002, China held approximately $100 billion in U.S. Treasury securities, mid-2000s to 2010. Rapid growth. From 2005 to 2010, China's holdings of U.S. Treasuries grew rapidly. This growth was driven by China's policy of maintaining a stable exchange rate for the yuan, which involved buying large amounts of U.S. dollars and subsequently investing in U.S. Treasury securities. By 2008, China's holdings had surpassed $500 billion. This period also saw the global financial crisis, during which U.S. Treasuries were viewed as a safe haven, further boosting China's investments. 2010 to 2014. Peak holdings. China's U.S. Treasury holdings peaked between 2012 and 2014, reaching over $1.3 trillion. This peak reflected China's continuous trade surpluses and the ongoing strategy to manage the yuan's value by accumulating dollar reserves. In 2014, China held about 40% of its foreign exchange reserves in U.S. Treasuries, marking the height of its investment in U.S. debt. 2015 to 2019. Gradual reduction. Starting in 2015, China began to gradually reduce its holdings of U.S. Treasuries. This reduction was partly due to China's efforts to diversify its foreign exchange reserves and mitigate risks associated with holding a large amount of dollar-denominated assets. Additionally, China's economic strategy began to shift towards promoting the international use of the yuan, RMB. By mid-2019, China's holdings had decreased to around $1.1 trillion. 2020 to 2024, accelerated decline. From 2020 onwards, the decline in China's U.S. Treasury holdings accelerated. This period saw increased geopolitical tensions, trade disputes, and concerns over potential U.S. financial sanctions. Additionally, rising U.S. interest rates reduced the attractiveness of U.S. Treasuries as an investment. By July 2024, China's holdings had decreased to approximately $0.8 trillion, the lowest level since the global financial crisis, marking a more than 68% drop over a decade. Let's take a quick pause. Could you do us a favor? If you enjoy our content, please hit the like button. To help even more, leave your thoughts and feedback in the comments. Your engagement helps us grow. Thank you. Why China still holds U.S. Treasuries. Holding U.S. Treasuries provides China with several strategic economic benefits. U.S. Treasuries are highly liquid assets, allowing China to quickly convert them into cash if needed. This liquidity ensures that China can readily access funds in times of economic stress or to address immediate financial needs. Currency management. By holding significant amounts of U.S. Treasuries, China can effectively manage the value of the yuan against the dollar. This practice helps maintain a competitive edge for Chinese exports by preventing the yuan from appreciating too much. The People's Bank of China, PBOC, uses U.S. dollars accumulated from trade surpluses to purchase treasuries, which helps to keep the yuan undervalued and Chinese goods competitively priced on the global market. Economic interdependence. Holding large amounts of U.S. debt creates a form of economic interdependence between China and the U.S. This relationship benefits both countries. China has a secure place to invest its foreign exchange reserves, and the U.S. benefits from having a reliable purchaser of its debt, which helps to keep U.S. interest rates low and supports economic growth. Trade balance management. By investing in U.S. Treasuries, China can recycle the dollars earned from its trade surplus with the U.S. back into the American economy. This practice supports the continuous flow of goods and services between the two nations and stabilizes trade relations. It also prevents an excessive accumulation of dollars that could otherwise destabilize China's currency and economic policies. Recent trends and future outlook. Recent trends indicate a strategic shift in China's approach towards its U.S. Treasury holdings, reflecting broader changes in geopolitical dynamics, economic strategies, and market conditions. This shift is characterized by a move towards diversification and reducing reliance on U.S. debt. Geopolitical tensions. Geopolitical tensions, particularly between the U.S. and China, have prompted Beijing to reconsider its heavy reliance on U.S. Treasuries. The potential for economic sanctions or other political maneuvers has highlighted the risks associated with holding large amounts of U.S. debt. This has driven China to explore alternative investments that can reduce its exposure to U.S. economic policies and geopolitical risks. China's economic strategy is also evolving. The country is increasingly focused on promoting the international use of the renminbi, RMB, as part of its long-term goal to establish the RMB as a major global reserve currency. By reducing its holdings of U.S. Treasuries, China aims to lessen its dependence on the dollar and encourage the use of the RMB in international trade and finance. This shift supports China's broader strategy of achieving greater financial and economic autonomy. Market conditions. Market conditions have also influenced China's decision to diversify its investments. The fluctuating returns on U.S. Treasuries and the potential for rising U.S. interest rates make it prudent for China to seek out other investment opportunities that offer better returns or more stability. Diversifying its foreign exchange reserves into assets such as European bonds, gold, and other commodities can help China manage its risk more effectively. U.S. election and China's decision. The election of Donald Trump could significantly impact China's policy regarding its holdings of U.S. Treasuries. Under Trump's previous administration, U.S.-China relations were marked by heightened tensions, including trade wars and increased tariffs on Chinese goods. A potential return of Trump or a similar Republican leader could reignite these tensions, prompting China to reconsider its U.S. Treasury holdings as part of a broader strategy to mitigate economic risks associated with political instability. If Trump were to implement stringent economic policies, such as higher tariffs or stricter trade regulations, China might find it strategically prudent to reduce its exposure to U.S. debt to avoid potential economic repercussions. However, the future remains uncertain, and we must wait to see how events unfold. That's all for this video. Thank you for watching. We sincerely appreciate you joining us today. If our content resonated with you or sparked inspiration, please consider expressing your support by liking it and subscribing to stay connected with our community. Your support holds immense value for us. You can watch another video from our channel, which is now on the screen.